If you listened to the experts who called for a market crash, you would have missed yet another incredible stock market performance. Here's why they were wrong. They said the market would crash. They said a recession is coming. They said to sell everything. And if you listened to them, you would have missed out on this. Take a look at this chart and this. Despite one of the fastest rate hikes in modern history, an event that should have sent stocks tumbling, stocks are on track for yet another strong performing year. The Dow is up over 12%. Gold is up 11.5%. The S&P is up over 23%. And Bitcoin is up 154%. Almost everything is up, including interest rates. But why? How can this be? The answer lies in a letter we wrote back in January 2021. What will stocks do in 2021? Here's an excerpt from that letter. It's important to know where and how money will continue to fuel the market. The first and most obvious are institutions. Experts keep telling us that equity outflows were high last year and that it's a sign of a bubble popping as institutions leave the market. Well, it certainly didn't end that way. Inflows into stock funds hit a 20-year high in November 2020. That trend continued in December. Overall, ETFs, a strong component of the new retail investor, posted a calendar year record inflow of $502 billion. Experts were right, however. U.S. equity funds experienced $241 billion of outflows for the year, 4 times the previous record of $58 billion set in 2015. But that's not all. Large growth equity funds had $66 billion of outflows in 2020, marking their 17th consecutive year of outflows. No one could have assumed that this is the result of money being pulled away from equities because investors expected the market to fall. And some of it was, as witnessed by the growth of money market funds. But merely looking at equity fund flows to gauge future stock market performance and sentiment is like investing without level 2 market depth. You just don't have a clear picture. So let's dig a little deeper. In 2019, 1.77 trillion shares traded hands, over 9 billion trades. Those trades were worth $81 trillion. In that year, the S&P 500 was up 28%, the Nasdaq Composite was up 35%, and the Dow was up 22.3%. The next year, in 2020, 2.76 trillion shares traded hands via 14.8 billion trades. Those trades were worth a whopping $121 trillion. The S&P 500 was up over 16%. The Nasdaq Composite was up a staggering 43.6%. The Dow was up only 9.7%, including dividends. Despite the COVID pandemic, stock market participation and liquidity grew significantly and, most importantly, to the upside. Therein lies the reality of the fund outflows. The Dow, if you take away dividends, mustered up only a 7% gain on the year. Comprised of 30 large blue chip companies, the Dow is home to companies that have been around for a very long time. Nike, Disney, McDonald's, Apple, Microsoft. Because of their historical strength, these blue chip companies are a staple in many large equity funds. They're what most people consider safe stocks. But safe has significantly underperformed. Just ask anyone putting money into GICs with the hilariously misnamed high interest savings accounts. Not only that, blue chips are boring. Why is that important? Well, first, while institutions make up the majority of the market, they still need retail investor participation to fuel excitement and liquidity. The more retail investors participate, the easier it is for the institutions to make money. And retail investors are back in a big way. In 2020, retail investors made up nearly 20% of the market. And if the first few weeks of 2021 are an indication of what's to come, then the first half of 2021 could be just as big. Here's something via Reuters that we pulled up. Retail broker eToro told Reuters it registered more than 380,000 new users in the first 11 days of 2021, adding to the 5 million who used to trade it just last year. It says a third of its base joined in 2020 when trading on its platform surged 5-fold from 2019 to $1.5 trillion. As I mentioned last October, via my letter Rise of the Retail Investor, this trend is only growing and institutions are betting on it. Here's an excerpt from that letter as well. If the actions of the big institutions are any indication, then my prediction of a continued bull market could prove true once again. Here's another excerpt from CNBC that shows exactly what the institutions are doing. Fidelity just announced its plans to hire 4,000 people in the next 6 months, plus is recruiting 1,500 college students for internships and full-time work. Morgan Stanley is buying Eaton Vance after snapping up E-Trade earlier this year as it continues to pivot from Wall Street to Main Street. BlackRock, a major institutional player, said it's been capturing more retail money too. When big firms switch strategies from Wall Street to Main Street, you know they expect big things from the retail investor. End excerpt. This trend hasn't stopped. Earlier this week, IG Group Holdings PLC agreed to buy American online broker platform Tasty Trade for $1 billion, adding 105,000 active retail accounts. That's a massive bet on a small number of investors. Nonetheless, it's a bet to tap into the rapidly growing retail market, one that IG clearly believes will continue to boom. And I bet they're right. 3 years ago, in my letter, Top Sectors to Invest in 2018, we wrote, "The torch is being passed from the baby boomers to the millennials. Millennials will become the decisive force driving our economy through interaction across economic, technological, social, and political realms. As digital natives who are global and interconnected, they have different views and approaches to banking and investing, different views of energy, and different expectations and priorities, both from a social and political perspective. They will soon become the dominant generation of active workers and, as such, will be the focus of politicians and corporations moving forward. If it weren't for the politically correct and liberal nature of millennials, Trudeau might have never been voted in as Canada's PM. If it weren't for millennials, Amazon might not have become one of the biggest retailers in the world. From corporate buyouts that cater to millennial consumer startups to the new era of clean energy brought on by millennials who demand it, the shift in corporate focus is targeted directly at the next generation. That means the biggest growth sectors and developments will be aimed at millennials and their plans for an on-demand, connected, and automated future. They will be the drivers of new investment trends and ideas, and they are the ones who will drive share prices higher. And boy, did those statements prove true. The share prices of companies within the clean energy space, think Tesla and NIO, and on-demand platforms, think DoorDash, Netflix, and Amazon, have skyrocketed to incredible valuations. When we wrote the above, Tesla was trading at around $62. Today, it's at $846, a gain of nearly 1,300%. But that's not all. Just over a year ago, millennials had an abundance of debt and little to no net worth. In fact, a study by Deloitte in 2019 showed that the average net worth of an American millennial was only $8,000. But in just a year's time, and incredibly through a politically induced shutdown of the world's economy, things appear to be changing. Here's an excerpt from Bloomberg. Millennials are enjoying rapid gains in net worth. Between 2019 and the third quarter of 2020, the aggregate net worth of those Americans increased by 21%, while the net worth of Generation X between ages 40 and 55 rose 8.5%, and baby boomers born between 1946 and 1964 saw a 4.3% wealth gain. As I mentioned before, the majority of millennial investors have missed most of the last decade's historical bull market run, but they're rapidly jumping back in now. For example, Robinhood, an online trading platform, said that half of its new accounts in the first half of 2020 were from first-time investors. There's no doubt that the advent of commission-free trading has propped up the market. It has paved the way for the creation of a new economy by millennials and Gen-Xers, the financial economy. And that means the biggest economy in the world just got bigger. The new normal isn't about wearing masks or social distancing. The new normal is a shift from a labor-driven economy to a financial economy. We already know that robots, AI, and more efficient platforms such as driverless cars will take over many of the jobs that exist today. This will force governments to provide a basic income, just as they have through last year's pandemic. We know now what happens when millennials and Gen Xers lose their jobs. Governments give them a check, which they in turn invest and day trade to make more money. And while they may not be playing with much, they are playing together. A single termite can't build even a small hill, but a collective can build a kingdom. While many invested in stocks during the onset of the pandemic, many more saved their money, including the free money they received from the government. In fact, millennials' cash and bank deposit holdings rose by more than 80% last year, from $100 billion in 2019 to $216 billion in 2020. In other words, the consumer is flush with cash and wants to spend it, especially if COVID dies down in the summer, which I believe it will, and the economy opens back up. What happens when consumers spend? It all goes back to the corporations. Mark my words, there will be record corporate profits this year. While many argue the Fed and other central banks have printed too much, they forget to argue the other side. That is, where there are liabilities, there are also assets. The key is translating those liabilities into growth, and that's exactly what the Fed has done. 5 years ago, the money went to corporations, and thus the stock market. To understand this particular scenario better, go back to July 2014 on our website at www.equidia.com and search up how the Fed influences the stock market. The Fed had to rely on banks to drizzle the money printed into the economy. As we witnessed over the last decade, that is a long and lengthy process. But that was then. Today, we have governments around the world directly giving money to their citizens. We have governments paying the wages for corporations, leading to record profits that will continue to balloon when consumers spend the money that the very same government has given them. All central banks have to do now is inject money. Governments hand it out, and the stock market goes up. In turn, investors make money, and it happens all over again. Now imagine that. No jobs? No problem. Just invest. It's the new financial economy. Back to today. If you're scratching your head, wondering why the stock market continues to climb, there's your answer. The new financial economy. The new normal is a shift from a labor-driven economy to a financial economy. The value of the stock market in the US is already 160% of its GDP. In Canada, it's over 141%. In other words, if you're one of those who tells everyone to stay out of the stock market and relies on the idiom, an honest day's work, you're going to be left behind in the new financial economy. Those honest day's work jobs won't be around for much longer. This isn't to say that stocks can't and won't crash, but the future will absolutely be dominated by AI and robots, and us mere mortals simply cannot compete. The only way to compete is to let our money work for us by investing in the right sectors and stocks at the right time. Heading into 2024, we will most certainly see volatility. In Canada, a lot of mortgages are up for renewal, which could put a serious strain on the housing market. In the US, not only is it an election year, but the events created by our world elites are a direct attempt to disrupt the world and shape its future. For example, while lithium and lithium stocks have dropped recently, the green future the elites have planned are still a go. Nuclear will continue to dominate. Healthcare is another sector that will continue to see advancements. New forms of diagnostics and therapies are emerging, and AI and machine learning models will speed up advancements in all of these areas. In addition, cancer rates and other ailments are once again seeing an increase after many years of decline. This will put a strain on the healthcare system, forcing governments to act quickly. For example, the American Cancer Society just changed lung cancer screening guidelines last month, making way for another 5 million Americans to receive annual screenings. This is in addition to the 15 million who already qualify. In turn, more funds will be allocated to this sector. And yes, AI and machine learning will most definitely remain a focus in almost every industry. However, your best bet isn't simply to bet on AI via AI stocks, but bet on those companies who can effectively use AI and machine learning to make advancements within their key sectors. In other words, a wise and patient investor should not let volatility be their guide. Let it be an opportunity. Until next time, seek the truth and be prepared.